Hello and welcome to the Killik and Co market update. Last week we talked about the market weakness that we've seen over the course of 2022 so far, and this week markets have continued to be very volatile. We've seen some big movements up and down, and the upshot is that markets are pretty much back to where they were a week ago. Today I thought it would be interesting to have a look at the performance of some different market indices so we can get a feel for how different companies have performed in the recent sell-off. So on this chart here we've got the 2-year performance of 4 different indices. In the purple we've got the Nasdaq Composite, which is a very tech-focused US index. In the orange, we've got the Russell 2000, which is a US smaller companies index. So the Nasdaq Composite and the Russell 2000 are both very growth-orientated indices. And you can see they both performed incredibly well in the aftermath of COVID, but they've both been hit particularly hard in the recent market sell-off. Now, when investors invest in growth companies, they're really waiting for those companies to become bigger and more profitable in the future. And you could consider that the risk-free rate, which is really the rate of return that these investors could earn by leaving their money in cash or investing in low-risk government bonds, that risk-free rate is really the opportunity cost of waiting for these companies to grow. And as interest rates start to rise and investors can get a higher rate of return from cash or government bonds, the opportunity cost of waiting for these growth companies to grow becomes higher. And that's why we tend to find that growth companies underperform in periods of rising interest rates. Now back to the chart, we've also got the S&P 500 index in the green. Now this is the biggest 500 companies in the US. It's a reasonably diverse index, but it's still quite growth orientated. So as you can see, it did perform very well in 2021, but it has also been caught up in this recent market sell-off. And then finally, we have the UK's FTSE 100 index. This contains hardly any growth companies. It's full of mature, traditional companies like banks, oil companies, insurance companies, companies that pay dividends. Now, it has been a very poor performer over the last couple of years. You can see it's only just scraped back to where it was pre-coronavirus levels, but it has been very resilient in the face of the recent sell-off. It's hardly sold off at all. And this really makes the point that it's really important to have a diversified portfolio with exposure to lots of different types of stocks. Interest rate expectations have been a key driver of the recent market weakness, and we had a good update from Jerome Powell, the chairman of the Federal Reserve, this week. He indicated that the first interest rate rise in the US will happen in March, but also that there could be several further interest rate rises over the course of this year. But inflation in the US has been running at high levels for quite some time now, so why is the Federal Reserve only just starting to take action? Well, the key reason is the labour market. 2 of the key objectives of the Federal Reserve are to keep inflation at a reasonable level and to support the US labour market, and those 2 things can be quite difficult to balance. If interest rates go up, that will bring inflation down, but it could also slow the economy, which could potentially harm employment levels. Here's a chart showing the level of unemployment in the US. You can see there was a huge spike during the first lockdown, and the level of unemployment has been steadily declining since then. The reading for December was 3.9%, and it was only at that point that the Federal Reserve decided the labour market was strong enough to withstand the shock of an interest rate rise. Clearly, the level of future interest rate rises will depend closely on what the labour market is doing, so we'll be keeping a very close eye on that. And finally, this week, the oil price has gone back up to $90 per barrel, and that's its highest level since October 2014. And this is due to the fact that demand has gone up as the global economy has continued to reopen, but it's also due to the fact that some investors are concerned about the tension between Russia and Ukraine, and some investors fear this could cause a hit to short-term oil supplies. Over the last few years, oil company shares have become quite unpopular, whereas investors have been piling into clean energy stocks. However, over the last few months, this trend seems to have partially reversed. On this chart here, we've compared the performance of 2 ETFs. The first, shown by the pink line, is the iShares Oil and Gas Exploration and Production ETF. The other, shown by the green line, is the iShares Global Clean Energy ETF. You can see that between 2018 and 2020, the oil ETF lost over half its value, whereas the clean energy ETF performed very well. However, over the last couple of months, as the oil price has risen and oil companies have become more profitable once again, we have seen a recovery in the price of the oil ETF, whereas the clean energy ETF has been caught up in the recent growth stock sell-off. Moving on to have a look at next week, it's very busy on the corporate calendar, and next week is a big week for tech stocks. We've got results out from Alphabet, Meta Platforms, and Amazon. That's it from us. Enjoy the weekend, and we'll see you next Friday.